everyone to today's session, Financial First Steps. So just a little bit about myself. My name's Nadine Reynolds, like I just said, and I'm a financial wellbeing consultant at Better With Money. We are an independent company that provides webinars in the workplace, help bring money matters to life to reduce money stress, and I'm going to be the presenter for the duration of this session. Now, just a couple of technical things, just a couple of notes. So this webinar is providing information only. It is not financial advice. My aim is to provide you with the knowledge and tools to help you take better control of your money. Also, Better With Money is not connected to any other organisation, and we don't receive financial incentives from any company for mentioning them. So if I do mention companies or websites along the way, it's because we genuinely believe that they offer good services and that they are value for money, which you can take advantage of. So let's have a look what we're going to be covering today. So we're going to look at getting organised and budgeting. So it literally is the financial first steps. What do you need to get organised and to do a budget? We'll look at understanding your payslip, because sometimes that's an area where people don't fully understand. They just look at the bottom line figure, but they don't understand what's actually going on with that payslip. Choosing the right bank account. Some of us may not have had bank accounts in the UK before, or we may have had bank accounts that we set up when we were children and we've just carried on using them. So, you know, with it, like with any financial products, you must shop around and get the right bank account for you and what stage of life that you're actually in. And then let's have a look at workplace benefits, you know, tuning into those benefits and knowing exactly what you've got and how literally your workplace benefits can benefit you. And then we'll have a little bit of time for Q&A. If at any point we don't have enough time to address all the questions, we will, address those offline and do a separate session. Okay, so let's crack on with the first, subject. So one of the best tips I can give you about planning your money is to get organised. And that means finding a financial filing system that works for you. So, you know, when you get those documents through, like insurance certificates, pension statements, pay slips, you need to know where to find them quickly and easily if you do need them at any point. Otherwise, paperwork becomes the biggest barrier to taking action if you don't know where to find the right information. So personally, I do mine in two ways. I have a metal filing cabinet, and it's just a small box metal container where I put all of my paper. And I know in this day and age, we don't get much, paper kind of statements and policies, but when you do get one, have a place to put that. What I also do is I don't file them away straight away. I have a little basket. I open the letters, read them, see if there's anything that needs to be addressed there and then. If it's not, if it's just information purposes, then I put them in the basket and I say once, twice a month, I have an actual filing session where I go through that, look at it again, make sure there's nothing I need to do, and I put them into my main filing system. Another one is if you maybe are more digitally still getting paper versions of things, is take a picture of them. Take a picture of them, scan them, and pop them into the iCloud, your memory system, or whatever you've got. That might be a good way of addressing that. Maybe keep the paper documents for a little amount of time, but if you've got a copy of that in your iCloud or whatever it is in the cloud, you might be okay with that. Also, if you are getting a lot of these documents via email or on online portals, it's good to have files within your email system. So that might be something, for example, with my email system, I have a folder for car and insurance documents. I've got gas, electric filing system. I've even got a file for my son's school, dinner money and anything that expenses that need to go out. So that's one way of doing it. So really, there is no excuse whether you get your paperwork digitally or physically. You know what I mean? There is a way of creating that financial filing system to get you organised. Keeping it together is absolutely key. The more organised, the better. So also, on the flip side of this as well, is think about, and this can be a little bit morbid for some people, but I talk about it all day long, so it's, quite a natural subject. But if you were no longer here, could somebody else work out where to find things and what policies you have? Possibly the answer is no. So this is another really good starting point to manage your money better. So this is a conversation I've had with my parents, I've had with my best friend, just to say, look, if anything happens to me, and it might be just that I'm incapacitated in hospital or something like that, there's BUPA documents that they might need to get hold of. They know where to find them in my house. So that's something that's taking the stress off them. It's literally a 2-minute conversation you can have with your loved one saying, look, X, Y, and Z is there. My will, my BUPA, is in that filing system. It's in the wardrobe. It's under the stairs. And, to have that conversation. So, something just to bear in mind, if you're no longer here or you're incapacitated, would people know where to find all your financial documents? Now, the next stage is knowing your budget. So your budget is quite simply what income you've got coming in and what you have to pay out each month. It's as simple as that. What's coming in, what's going out. The aim is to cover your bills and in an ideal world, have a little bit spare at the end of each month to save towards your money goals. So for many people, having money left over isn't necessarily achievable, especially, with the cost of living at the, and I was going to say at the moment, but I think, this is how we live now with the cost of living. But it's trying to make sure you have the knowledge as to how much life is costing you and have a realistic view so you can manage your money accordingly. Now, you don't have to have anything fancy to do a budget. You can use a pen and paper, you know what I mean? Literally left-hand side for money in and right-hand side for money out, as simple as that. But there are lots of free tools available online to help you budget. And many banks actually offer budgeting tools within their apps. So it might be like balance after bills, or it might be an actual budgeting tool. But, we have budget planners on our website, the Better With Money website. So if you go on there, if you look along the top, there's an employee resource section on our website. So there's interactive ones, there's ones you can print off. Even built, if you've got an iPhone, even built in your iPhone, there's a budgeting tool. So we've all seen the Numbers app on our iPhone. I used to just dismiss this in years gone by. But if you actually go into that Numbers app and you scroll down, there's a personal finance area and you can do a budget within there. What I would say is whatever tool you use, whether it's a spreadsheet, pen and paper, you use the apps, or you use your banking apps, I think it's useful to break down your spending into 3 areas. So you must break it down into your essential spend. So essential spend is what keeps a roof over your head, food in your stomach, them lights on. Then have a look at your debt. If there's any debt, car, finance, loan, phones, anything like that. And then, the day-to-day, what we might call, the fun stuff. Think about, takeaways, going out, what you might spend on clothes, and work out what that is costing you. Now, to find out what that's costing you, my suggestion is that you print off a copy of your 3 months bank statements. So look back to be able to plan forward. So by looking at the last 3 months and going through it with a fine-tooth comb and a highlighter pen, a couple of different coloured highlighter pens, and earmark off your essential spend in one colour, what keeps that roof over your head. Then in another colour, look at your debt, any loan, any kind of payments like that. And then look at the miscellaneous. What are these $10.99, $9.99 going out a month? And that will give you a true reflection of what you are spending. Because when we first initially do a budget or a budget planner, we do what's off the top of our heads and we're not being realistic. And then when the end of the month comes, we're wondering why we've not got enough money left. And that's because we're not taking a true picture or a true reflection of what we're actually spending each month. So this allows you not to overlook any payments such as that Amazon, that Amazon spend, or that trip to the shop where you wanted to spend, just buy bread and milk, but you ended up coming out with a lamp and a bale of towels. That's something that often happens to me when I nip into my local supermarket. I don't come out with just the bread and milk. I come out with all sorts. A blooming candle and a new top. That's what happens, isn't it? So by going over that last couple of months, it will give an accurate picture of what you're spending. Whilst you are doing your budget, it is worth digging deeper into those things that you may happen only once a year or occasional spending by filling out an annual budget planner. So I'll give you an example of myself. So I know that every January, and it's a terrible time of year, but every January my car, MOT, my car tax, MOT and insurance is due. So, I try and budget for that a few months leading up to January. So from about, October, November, I start putting a little bit of money away so that I'm not really suffering in January trying to find that. So things like Christmas, birthdays, other celebrations, other festivities that might only happen once a year. It's a good practice to work out the annual cost if you can and divide that by 12 to see what you need to be saving for these events throughout the year. And once you filled that out, you know, what you spend versus the money coming in, you should be able to see whether you have some spare money each month, you know, by doing these budgets, and whether you can save for emergencies or your money goals. Your money goals might be a holiday or getting married or buying a house, or particularly whether you're in a situation where you may have a shortfall. So if you have a shortfall, try and be honest with yourself where it's coming from. Could you cut back on anything? Could you cancel some of those standing orders, direct debits that you might have don't even realise are coming out of your account? These small changes can make a big difference overall. Just want to chat a little bit about the 50-30-20 rule. So this was introduced by, I think it was the US Senate. They came up with this budgeting rule, and it's where ideally, in an ideal world, 50% of your income should go on essentials. Again, that keeping a roof over your head, food in your stomach. 30% of your income on nice to haves, and 20% on either savings or paying off debt. So when you first do your budget, or you do your, you know, going through your bank statements, it may not look like anything like 50-30-20. I know at the moment I'm probably on 70-20-10. Some of you might be on 60-20-20. So when you first do it, it might not look like 50-30-20, but it's a nice kind of aim to try and get to that only 50% of your income goes on those essentials. So like, again, it's a nice little kind of, you know, nice to try and get to, but do not worry if initially you're nowhere near this. It might be something you strive towards. And when you're doing this budget and you're doing, you know, recapping your bills and you're recapping, you know, what you're spending, review it regular, because there can be changes within your lifestyle. So a budget that you had 2 years ago might not be relevant now. You might have a wife and 3 kids by now, or a partner, or you might have got divorced. There might be all different kinds of life situations where your budget isn't relevant from a few years ago. So always review that. I say once, twice a year, just make sure you're on track and that everything's looking okay, especially with mortgage payments going up and gas and electric. At the moment, we're in summer, so we're not going to be, seeing high bills, hopefully, but then we have to be prepared for winter again, because we don't know what that's going to bring. So again, by reviewing it regular, you can take into account these different changes. Right then, so let's have a look at choosing the right bank account. So the next thing for us to consider is our bank account. Many of us will have our bank accounts open for us as children, but these accounts might not be the best ones for us now once we start work. And, you know, like most things, you must shop around to make sure you have the best financial products, the best deals, and the best bank account that works for you. So by shopping around, a really good website to look at is the Money Saving Expert Compare the Best Bank Accounts. I've recently done a bank account switch. I've transferred an account from one provider to another. I actually got £200 for doing that. So there was a financial incentive for me to do that. That was £200 back in my back pocket. But also the account was, you know, offering quite a few extras that I wasn't getting in my the account that I had at that point. So shop around, make sure that they're doing the best things for you. You might have a packaged account. You think, well, actually, I don't need travel insurance, mobile phone insurance, or breakdown cover now. So why am I paying out each month for that? So again, make sure that the bank account is working its best for you. There is no reason, there is no loyalties now for staying with the same provider for years upon years. Sometimes it is best to switch and find out what fits for you in your life now, and if there are better deals out there. Just want to mention, if you have recently graduated, because this is, you know, financial first step, so you might be in a position where you're just starting out in your career, then the likelihood is a graduate bank account will be best for you. So if you, a graduate account is if you've had a student account, you come out of, you know, studying, you've been to university, and then you switch into a graduate account. If you haven't been to university, you won't have access to a graduate bank account, but there's plenty of other bank accounts to choose from. But how do you know which one to opt for? So again, it's by going on, you know, the different kind of websites, Money Helper, Money Saving Expert, and shopping around. And if you are a graduate, I put the details on screen, savethestudent.org, that's got a really good article in there about, you know, the different types of graduate accounts that you may want to go on to. Now, what I would suggest that you choose an account which offers, the best fees. So you're looking at those hidden fees behind what's going on with overdrafts, what's going on with kind of, using debit cards, because you might travel a lot and you want to use debit cards abroad. So just don't take the headline offers when you are looking at the bank accounts. Look at what's behind that and what kind of charges there may be involved with using cards and overdrafts and things like that. As a word of warning, banks changed the way in which they were charging for overdrafts a couple of years ago. And nowadays, once you exceed your interest-free limit, so if you have an overdraft in place and an agreed overdraft and you go over that, you may get charged around 40% interest, which is double the interest you may pay on a credit card. So please make sure that you're not going over your limits and paying those high charges. Now, if you are looking at, if you are a graduate, going back to that, it is worth checking that the kind of fees that are involved there, because some of the accounts have kind of a sliding scale of how they deal with the graduate bank account. So I know HSBC earlier this year, they were offering a £3,000 overdraft in year one. That reduced to 2,000 in year two and £1,000 in year three. So just have a look, if you are looking specifically at graduate accounts, what they're offering, because sometimes they say, oh, we'll give you a rail card, we'll give you this, we'll give you that, but just double check at what the background charges are. Again, don't just go for the headline offer. Now, it's good to check, what the offers are when you're going through any kind of bank accounts at all, but just make sure that they are fit for purpose and that you are doing your checks with anything when you're looking for the right bank account. Now, we've looked at sorting out financial paperwork and choosing the right bank account. Now let's have a look at payslips. So don't underestimate these powerful little packets. It's a great life skill to understand what is going on with your payslip and also become familiar with other pay relevance, indicators that are on here. Some people will look at the pay slips every month, absolutely brilliant. I must admit, this is something that I do, but I do work in the financial wellbeing sector. So if I didn't do it, there'd be an issue. But it is something I do check over each month to make sure that everything's looking okay on it. Now, most of the majority tend to look at the pay slip if something isn't matching what lands in our bank account. And that's the only time we actually go and have a look at the pay slip. Now, speaking from experience, in those moments, you might be a little bit flustered if what hits your bank account isn't what you're expecting. So, that's when you'll realise when it's a really good skill to be able to open a pay slip and actually understand it. So one of the key things we need to understand when we get paid is what deductions come out of our pay. We very rarely talk about the components on a pay slip, which is why I've included it in this webinar. So here's an example payslip for someone earning a basic salary of £30,000. Payslips can have different design and the boxes can be in different places, but most of them are based on the information here. The first thing to understand is your tax code. So halfway across and 2 rows down, this tells you what your personal tax allowance is. So your personal tax allowance is the amount of money you're allowed to earn each tax year before you start to pay income tax. You get a new tax code every year, and for this year, which runs from the 6th of April to the 5th of April next year, the standard personal allowance is £12,570. This means you can earn £12,570 before you start to pay any tax. It could be lower if you owe tax from previous year's income, or if you have certain benefits that you have to pay tax on, such as private medical insurance or company cars. So your tax code is your personal allowance with the last number chopped off and a letter added. So for most people this year, it will be 1257L. L means you're in England, and this will change to S if you're in Scotland or C if you're in Wales. The best way to check your tax code is based on your earnings, is to register for an online HMRC government gateway account, which is like online banking, but for your salary and tax. You can do this at the gov.uk website. I cannot recommend this enough, guys, to get that account. It shows any benefits that you might get in, child benefits, things like that. It shows tax credits. It shows your income from HMRC, from your pay. It also shows you national insurance contributions, and you can also do a calculator of what state pension you might be able to get. If there's one thing you take from today's webinar, is to get yourself one of these government gateway accounts. It's absolutely priceless. And you can actually pop it onto your phone as an app as well. So it's something that I check on a regular basis to make sure that everything's okay. So please download that and get your government gateway account. Now, back to the payslip, that brings us on to tax. So income tax, I'll give you a little bit of a fact here, was introduced more than 200 years ago when we needed money to pay for the wars against the French leader, Napoleon. Then the income tax system of pay as you earn, so PAYE, was introduced to pay for the Second World War. And although this has evolved over time, it's still in place today. So it's the biggest source of income for the government, making over 25% of their money, and it's used to help provide funding for public services such as education, as well as investments in projects such as roads, rail and housing. Income tax is made up of different bands. So for example, basic rates at 20%, higher rate at 4%, and additional rate at 45%. This means as your income increases, so does the amount of income tax you pay. It's an attempt to make paying income tax as fair as possible so that those who earn the most contribute more. In England and Wales, you pay a basic rate tax on the first 37,700 of your pay over your tax allowance. For most people, you'll only start paying the higher rate tax of 40% when you have earnings over 50,270. Little table on the screen to explain this as I'm talking. So as an example, if you earned 51,000, you'd pay no tax on the first 12,570, 20% tax on the next 37,700, and then 40% on the remaining £730, taking you to 51,000 in total. Slightly different in Scotland, but you can find out all about the income rates in Scotland at gov.uk. The other thing that's deducted from our pay is national insurance. So national insurance was originally introduced in 1912, and bills are entitlement to certain state benefits such as statutory sick pay, state pensions, and they also go towards paying services like for the NHS. You'll get allocated your national insurance number just before your 16th birthday, and this remains the same throughout your life. Learn it off by heart is my top tip. Unlike income tax, national insurance is not an annual tax. It applies to each of your pay periods, whether you're paid weekly, monthly, or some other period. This means if you earn extra in 1 month, say through a bonus, you'll pay extra national insurance on that, and you won't be able to claim that extra back, even if your pay is lower during the other months of the year. The threshold is at which you start paying national insurance is known as the lower earnings limit, and the government increased this in July to bring it in line with tax. So you only pay national insurance if you earn more than 12,570 or £241 a week around that, and you stop paying once you reach state pension age. The more you earn in a month, the more national insurance you'll pay. But you won't be able to claim that extra back if you are overpaying, even if your pay is lower during the other months. So just to summarise your payslip, by law, everyone's payslip must show your gross pay, your net pay. So your gross pay is earnings before deductions, and your net pay is pay after tax, national insurance, and any other deductions being made. If you're paid hourly, and the hourly rate. So generally, the left-hand side of a payslip is what you're being paid. So that's the 2,500 figure. And the right-hand side is any deductions being taken off. So the deductions are £631.60 in this case. In this example, this person is paying their student loan and into a pension too. So most people want to just know the bottom right-hand corner, which is your net pay, as this is the amount that actually goes physically into your account and what you use for budgeting purposes. I hope that's clear. Again, ask any questions throughout the session and we'll address them at the end if there's anything you want to clarify. Now, a term to become familiar with is salary sacrifice or salary exchange, two names for the same process. Often when working for an employer, they'll set up benefits you offer using this process as a way of reducing the amount of national insurance you pay. Salary sacrifice is predominantly used for pensions. So rather than the employer pay you money and then you pay into your pension, you agree to sacrifice that part of your salary so that the workplace paid directly into your pension without paying it to you first. If it's not paid to you, you won't pay national insurance on that salary. So it saves you even more money and it saves the employer money too. So salary sacrifice can be used for other benefits too, such as critical illness, bikes to work, all those other kind of examples. The other thing to watch out for is that you can sacrifice salary below the national minimum wage, but payroll will be watching out for that. So the main message about salary sacrifice is you can save you money, and it also reduces your national insurance deductions as well. As well as your pay slip, you'll be receiving some other legal documents relating to your pay. So we'll run through them. Again, speaking from experience, being handed these to you, you know that they're somewhat important, but you're not sure exactly what they do. So a P60, you get one reliably every year, and it tells you your total earnings for the year and total tax paid. This can be helpful for if you're applying for a mortgage or if you have to do a tax return, which we'll come on to. P45, that's what you get when you leave an employer. Don't bin it, because if you then move to a different job in the same tax year, they need your P45 to know how much tax you paid so far and to sort out an accurate tax code. And the P11D, this is from your employer each year, listing your benefits in kind, which means benefits your company are paying for you on your behalf. Therefore, you need to be taxed appropriately. So, for example, a benefit that you might have to pay is private medical insurance. A P11D will be submitted to HMRC each year automatically by your employer. Now, another term you might hear thrown around is self-assessment. So this is usually around January, as it's an online deadline for people to submit them. So a self-assessment tax return is a way of HMRC checking you've paid the right amount of tax in a year. Most people who have one job and earn less than 100 grand don't have to do them, but we've detailed on the side those situations where you may need to do that one. So if your employee earning more than 100 grand a year, your income tax from savings was more than from savings was more than 10,000 a year. You're a director of a company. You've had self-employment income of more than 1,000 a year. You claim child benefit and your income is over 50,000. You've earned more than 250. You've earned more than 2,500 per annum in tips or commission, or you receive rental income or have income from abroad. If you do need to do a self-assessment tax return, then you can do this online via that HMR online account that I mentioned. You can do it yourself, or you can ask a tax advisor or an accountant to do it on your behalf. Most people with simple circumstances will do these themselves. But, likelihood, if you're not in any of those situations, you probably won't need to do a self-assessment. Now, to finish the session today, just want to mention workplace benefits. On this slide is a list of questions that you may want to ask yourself within your current employment, and these also must be asked when taking on new roles. Workplace benefits are something to tune into whatever you do for work, because more than often, you're going to get the best deals through work. Most employers offer core benefits, which everyone, gets, such as life insurance or, bikes to work or things like that. And other benefits, which are optional, are paid for by you, but are often discounted. So when you interview at future companies or any employment, it's good to ask what workplace benefits there are, because these can really be a boost and an enhancement to the job role. Because it's not always about what you're getting paid, it's what comes with that job. What's the pension scheme? What's the benefits? And as we go through our career, some of these benefits can be quite significant. So, workplace benefits are absolutely something to engage with, and employers can pour a lot of time and love into what's offered to you, and it's there to boost the well-being of the workforce. So ask these questions. Even if you've been employed with the company for a long while, do you know what you're actually getting? How do you access these benefits? Is it through a portal or is it through an app? What benefits are available to me? Am I making the most of the pension scheme that's on offer? Are my nominations up to date? So nominations is if you've got a life insurance plan or something like that, have you got an expression of wish, a nomination or a beneficiary, where that money will go to if anything happened to you? And what's the sick pay? What happens if you can't work? Do you know what the sick pay is? Do they pay you for a certain amount of time, or do you go straight on statutory sick pay? So again, it's something to actually, you must review these and make sure you are aware of what's going on. Now we're coming to the close of the session, so I just want to go on through the action plan, what we've talked about today. So create your financial filing system. Make sure that's the biggest barrier to action. Have you got a pile of paperwork that's stacking up and you've not addressed for a long while? Get that sorted. You will feel so much organised and a weight will be lifted off your shoulders. Know your budget, what's coming in and what's going out. You know, simple as that. You don't have to use anything technical. It doesn't have to be Excel spreadsheets, but just know what's coming in and going out and cut your cloth accordingly. Choose the right bank account, whether it's bank accounts, loans, mortgages, credit cards. Make sure you shop around and get the best deal. That Money Saving Expert website is absolutely, you know, a brilliant tool to do that. Check your payslip. Check it. It takes 30 seconds. If you log on online portal, check your payslip, check that everything's okay with that, and check out your workplace benefits. You know, is there anything that you can be making use of or utilising a lot more than you are doing? I'm just going to pop on the last screen before I close, you know, some help and support that you may need. That's available through the Benevolent Fund, and all the hotlines, all the information, all the website addresses. I'll leave that on screen. I'm going to finish there and we're going to go to questions.
Thank you very, very much. Lots of really excellent content there. So to start off, I'm opted into my employer's pension scheme. Is this worthwhile, or is it better to source an external pension supplier that I can take from job to job?
What I would say that the most tax efficient way of saving is through your pension scheme, if you want to save through retirement. And that's through your workplace pension scheme. That's because you get full tax relief at your highest rate on any contributions you pay in. The contribution is paid via salary sacrifice when you do it through a workplace, which means you'll save the national insurance on it too, like we mentioned earlier on in the presentation, as it's taken from your gross salary. Once the money is in your pot, it grows tax-free. And when you decide to draw in the money in later life, you know, you can draw on your pension from the age of 55, you can take up to 25% tax-free lump sum from that pot. Now, if you saved into an external pension, then you'll pay into that from your net salary. So you may have to do a self-assessment to recover this tax. So you won't get any of the and also you won't get contributions from your employer. So if you do a workplace pension scheme, you might, you know, contribute 4%, but your workplace might contribute 8%. So that means that 12% is going into your workplace, you know, pension scheme. So if you've got an external fund, a private one, we'll call it a private one, that fund might not grow as much as a workplace pension scheme because you've not got those additional contributions that are going in there. I hope that answers that question.
That's great, thank you. And we've just had a question come in, which seems quite a popular area of discussion at the moment. Is there a limit to how often you can change bank accounts and providers?
Now, there isn't a limit, but what I would say is every time you apply for any product, which includes lending, so that's bank accounts, that needs a credit check done on your file, then that will be a hard search on your credit file. Now, if you're changing your bank account, say every few months, that is hard search that are going to affect your credit file. So that's the ramifications. That could be the negative ramifications. Now, usually what the experts say is you could change bank accounts probably once, twice a year without it having a major effect. Because once you have a hard search on your credit file, it may lower your score, and it can take 3 to 6 months for your score to recover and get back to where it was. So that's the only thing to take into account. If you're not bothered about how your credit score is going to be affected, then yeah, change your bank account as much as you want. But obviously, if your credit score is being lowered by keep changing your bank account, then the likelihood of you getting these new products are going to be lowered because your credit score is going to be lowered. So I would space them out. I'd say once, twice a year, every 6 months, maybe. If you was looking at these best deals and you wanted these offers, that's probably the limit, because again, you've got to give your credit score time to recover. So I would say that's the only negative kind of you know, purpose on that. Hope that makes sense.
That's great. And just one more. Does marriage allowance still exist? And if so, does it extend to long-term cohabiting partners?
Right then, so marriage allowance, so we hear a lot about this. This lets you transfer £1,260 of your personal allowance to your husband, wife or civil partner. So what this does, it reduces their tax bill by up to £252 in the tax year. So from the 6th of April to the 5th of April the following year. Now you can benefit from marriage allowance if all of the following apply. So you're married or in a civil partnership, you do not pay any income tax, or your income is below your personal allowance. So do you remember that personal allowance of 12,570 we spoke about earlier? Your partner pays income tax at the basic rate, which usually means their income's between that 12,571 to the 50,270 before they receive marriage allowance. You can't claim marriage allowance if you're living together. You've got to be married or in a civil partnership for that. I hope that's clear. But with regards to that, just to pop in, if you've got any queries about that, go on the gov.uk website. That gov.uk website is absolutely brilliant. It gives you black and white facts. There's no beating about the bush. So there's anything about tax, allowances, national insurance, benefits, anything like that, go on that gov.uk website. It is a really good information source for things like this.